Hey, welcome everyone. Guess what time it is? We're calling all investors. We're live with Caeli Ridge. It is Tuesday at 4:30 p.m. Eastern. And you know what time that is, right, Caeli? It's time to speak to the community, to share what's going on, to share insights. If you're listening on the podcast, like always, we will always make these recordings available in the Ridge Lending Group community as soon as possible. We also have it on the podcast, so you can always catch our editions there. And each week we try to come up with something topical. And so this week is no exception. I think the big topic for today is, what will Jerome Powell, who is a Fed chair, in case you didn't know that, what will Jerome Powell tell us on March 21st? Caeli's got some predictions, but no guarantees because she thinks her crystal ball's on the fritz. I doubt that. And then we're going to get going and see what you have to say, Caeli. So welcome.
Thank you, Larry. Thank you, Larry. Hi, everybody. My favorite 30-ish minutes of the week is here. Excited to be with you as always. Okay, I'm going to get right into it. I had kind of an outline prepared for what I was going to be discussing today. But as is fairly common, I've noticed in the last 12-ish months, I can be derailed when I take a leap and start to count on expectations that the market may be doing X or Y or Z. And the reason for that is that most of you have probably seen the big headline the last half week or so about Silicon Valley Bank. This has sent the expectation, and maybe not, but a lot of predictions have now changed based on the failure of Silicon Valley Bank. And if you didn't hear, the second largest bank failure in US history is what I'm being told. That sounds like a fairly large number, but my sources are credible. I feel like back in 08, 09, there were larger names than that, but whatever. Let's just assume that that's accurate. You guys can do your own sleuthing. The failure of the bank, at least in part, was due to rising interest rates. So for that reason, a lot of people are speculating that the Fed then in the next week or so, their response may be to take the Fed fund rate and pause any increase in March. Some have even said maybe they'll come down or they'll reduce the Fed fund rate. I think that's highly unlikely. And then others are saying that they're going to keep along the same vein. And then finally, we've got people saying that maybe they increased just a little bit versus what the expectation was before. So everything that I was going to talk about today is now kind of up in the air. So what I'm going to do is I'm just going to kind of offer a little bit of my own perspective about all of this and what it means and kind of how I feel about it. And then we can open up for Q&A on this or any other topic, guys, because like I said, what I had planned is now kind of persona non grata.
So Caeli, just to let
Yeah.
you know, we do have a poll. I know how you love polls. So we do have a poll prepared for the group. And for those that are on call, there's about 29 attendees. So thank you very much for always coming to these. Please make sure that you use the webinar chat or the Q&A to participate. We are working feverishly with Zoom to make these back into meetings, because that's what we know collaboration does best. And we'll give you an update as we go. And Caeli, the poll that we have, and you tell me when you want to launch it, but the poll basically is rates going up or down, your choice. That's the poll. So you let me know when you want to go live with that.
I love that you did that. We didn't talk about this, Larry. We are just on the same mind zone space continuum thing. So don't do it yet. And the reason for that is that I think that my follow-up comments may change, because immediately everybody, when they heard you say that, they're going to have an opinion up or down, right? But before you get to answer, I want to offer a few details of my own, and potentially your answer may end up being different. So guys, we know that the whole purpose of the Feds and their continued language to us that says they are going to continue to increase the Fed fund rate, which, by the way, just for those that don't know or maybe don't remember, the Fed fund rate is an entirely different marker for interest rates than our long-term rates that we get for our mortgages. Very, very different. While there's a connection, they are not the same thing. Okay, just a reminder on that. But the Fed has been extremely clear on their intentions and that they're going to continue to rise these damn rates as long as it takes to get inflation under check. But what I want to share with you guys, what I want to say today is that ultimately we can't have it both ways. Okay, higher interest rates mean what overall? Cost of goods are going to be less. Home prices, home values are also going to be less. Interest rates are going to be higher. Yes, we understand that, but you can't have one without the other. If the Fed fund rate is higher, that means that our cost of goods are going to come down. Who cares about, the food and the gas and the cost of goods right now? If that's important to you, then you want the feds to increase the Fed rate, right? If we want home prices, if we want the housing market to kind of stable out, then we want the feds to continue to increase those interest rates. Now, I know that it bleeds into and it cuts into our returns on our investments, but so what? That's a shorter term thing. You need to be looking at different investments or diversifying in some way. Right? You guys know my stance on interest rates as it relates to our real estate investing and the returns of those. If we want gas prices to fall, if we want housing prices to fall, if we want food prices to fall, then rates have to go up. The flip side of this, and there's kind of a catch-22, and I want to come back really quickly to the Silicon Valley Bank. Another thing, and I think I didn't read, I just saw a headline. I think Biden had come out, and this isn't a political discussion, but I think that he is, that the feds are going to make good the investors in that bank, right? So if the feds do raise, and this is why some of the people saying that they may not raise the Fed fund rate, if they do, there's probably going to be a runoff in other like-kind regional banks. And what that means is a runoff means that people are going to start pulling they're scared, right? So Biden made an announcement and said that not to worry, other banks aren't at risk, that the feds are basically going to bail out that institution. But even still, if they raise the interest rates, human beings, I think, ultimately are going to start pulling their money out. That's a runoff, taking their money out of these other regional depository banks and sell of stock and all of that stuff. So that could potentially lead to more bank failures. So the Fed is in an even tougher situation than they were in before, because they have to keep that in mind as well. Raising the interest rate, if they do that, could contribute to that kind of runoff and more bank failures. Which nobody wants to see. But then again, if the United States government is going to bail us out, that's socialist capitalism at its greatest, I think. Then I guess who cares? But anyway, that's what I wanted to say. Let's take the poll now based on what I just shared with you guys, and maybe not so eloquent a way, but you get my point, I'm sure.
All right. So for those that are on the call, you should have a window that popped up. And the question is, rates going up or down, question mark. And of course, I had to put a third option in there, Caeli, for no change, right?
Sure.
Just to see if anybody's really like, nah, they're not going to, they never change. Sure enough, somebody picked no change. Power of suggestion. I will say this, I did read from several credible sources that the Silicon Valley Bank was the second largest since 2008 because of the assets. And what was really remarkable about that, and I got into a couple of tit for tats on LinkedIn, where some folks were like, well, if Barney Frank came out and had these rules, and he was part of as an investor in the bank, and now they're not following their own rules. I said, listen, we can do the politics later. I said, right now you got people who aren't getting their paychecks. I said, and I've seen a lot of companies had a lot of money in these banks that were shuttered, and that was where they had all their payroll. So that's the part that really freaked me out. Was
scary.
Scary stuff. So we're going to wrap up this poll. We got about 26 out of 39 folks. So we're going to count to 3, 2, 1. And we do have a couple questions, Caeli, when we're done with the poll here. All right, so here's the results. You should see them on screen. And so, Caeli, you've got 81% said up, 12% said down, and 8% said nope, no change.
Yeah, I love you all. Thank you, you guys. I think your instincts are right on the money. Not a trick question, but I think that for me, if I'm answering that question, I would say up to what end, right? Not just crazy up, not without any kind of tether. But I think up is the way that we want interest rates to go if we're all going to benefit ultimately in all of those different variety of ways and reasons. And remember, if those of you are saying up, you probably are thinking about the difference in as it relates to what we're talking about today. Why we're all here on this call is real estate investing, right? Interest rates have that psychological hook on us. But when we do the math, and we've talked about this so many times together, you guys, the difference in payment for us, principal and interest payment with a quarter point increase to rate or an eighth of a point increase to rate, whatever it is, largely dependent on the loan size, much higher loan sizes that's going to make a much bigger impact. But generally speaking, what I'm seeing come across my desk all day long are loan size relative to, it could be as low as 80,000 up to 250, sometimes 350, whatever, but that's still in that range where a blip of rate between an eighth, a quarter, a half, a full point, whatever, isn't as substantial a number as we make it out to be in our heads. So I agree overall, yes, up is where we want to see these things go for our own selfish reasons for real estate investing, our own selfish reasons for cost of goods, right? Our own selfish reasons for home prices, all of those things ultimately, I think, are going to help us to see interest rates go up in that manner. Not unchecked, but that's good. I'm so glad that you all kind of see through the minutia and the different headlines and stuff and have that informed decision, because that's the right answer. It's the right answer. Let's take some questions, Larry.
Sure. So the first one we got in was from Kevin Nguyen, and the question is about on your ongoing concerns about the Fed maybe changing some policies or the government changing some policies. So how do you see the bank requirements? How do you see those bank requirements possibly changing and possibly impacting lending to real estate investment folks?
It's an excellent question. I'm sorry, I forgot who the author was, but thank you for asking. Kevin, thank you for asking. So guys, I usually stick to Fannie Freddie because that's largely what most real estate investors, residential real estate investors are kind of focused on if they're still in that golden ticket bucket. And these guys have their finger on the pulse. I'll tell you what, they don't miss a beat. Well, they don't miss too many beats. But they're ahead of the game. They've already been making some of those changes and moves as it relates to your question, Kevin. So we're already seeing those, and those changes most recently have come up. Debt to income ratio, I think I talked about this in the last or one of the last meetings that we've had. Debt to income ratio requirements over a certain threshold, I can get into it if you guys want to, are now going to have an additional LLPA, loan level price adjustment, which means that those individuals that have over a 43% DTI, was it 40 or 43, Larry?
It was over 40 in some cases. It was a weird thing because it was 40 and then I think it was 43, but yeah, there was a 40 mark, which is weird.
Okay. So yeah, it is kind of weird because the when we start talking about ability to repay and some of the Dodd-Frank rules, 43 was a threshold. It doesn't matter. Okay. It means that now that we'll get you guys the exact answer, but not that it doesn't matter. It matters. But for our conversation, my point is that people now, there's a rule in place that over a certain debt to income ratio, because remember, 50% is the threshold, 50% DTI, and you can still qualify for a conventional loan. But what's happened is that they've made a new condition for it to be a Fannie or Freddie, a U.S. agency insured loan, that over a certain DTI, 40, 43, whatever it is, that there's going to be a loan level price adjustment to the interest rate. Now, this is a price adjustment, guys. So if the loan level price adjustment is a quarter hit, that doesn't mean that the interest rate is a 0.25% higher. It's a loan level price adjustment, not a rate adjustment, two totally different things. And that is a whole can of worms, Pandora's box. I'm not going to open up today. Maybe we can talk about loan level price adjustments on another call. If anybody's interested, let us know. But that would be the first thing. The other thing that we've seen recently in changing in guidelines, Kevin, is that 12-month seasoning on cash out refinances. That was a big one. Prior to, unless it was a delayed cash out refi, and I'll explain that in a second for those that want a refresher. Prior to the update or the change, it was a 6-month ownership seasoning before cash out refinance could be attained using an appraised value or an ARV, after repair value. Now it is 12 months. The reason for that doesn't necessarily have as much to do with this instance or what we're talking about here in the bank failing. It has more to do with the overall increase of rates and decrease of home values over time. It sees the writing on the wall and servicing rights. So what's happening with the seasoning piece, and I'm feeling like maybe we touched on this too, but I'll repeat that and then I'll repeat the delayed refi rules. The reason that they've upped the 12-month seasoning, or at least two of the reasons is that one, they're going to be doing cash out refinances on properties that we expect, that the market expects are going to be worth less in the coming months, maybe years, whatever, right? So lending on a value of X when they know that the value of Y is going to be relative in the next year, that's going to have an impact, the LTV restrictions, et cetera. The other thing that's happening is that we're in a high rate environment right now, and servicing rights. When an aggregator or a servicer picks up the rights to service your mortgage, they pay a premium for it. Okay, so when you talk about mortgage-backed securities that are bought and sold in the secondary market, when a servicer purchases a bundle of mortgage-backed securities, they pay a premium for those rights. It takes about 36 months to recapture that upfront cost to where they're profitable. Okay, we know that we're in a high rate environment. We also believe as a result of that, rates don't go up and stay up. They don't go down and stay down. They're going to move, right? So we expect that rates are going to start trailing off in the next year or two, but certainly before that 36-month window of profitability is met. So what's going to happen to those higher rate mortgages that were secured over the last year? Rates are going to come down. What are people going to do? They're going to refinance, right? They're going to pay off that mortgage before that servicer was given the amount of time to make good on what they paid up front. So that's another reason for the 12-month seasoning. Anyway, hopefully that answers. I think the final answer, I have to tell you guys about delayed refi in a second, but Kevin, the final answer is that they're usually ahead of the game when they start messing with policy and underwriting guidelines. We usually know well in advance of before even I get the information sometimes. So I think for that reason, there's not going to be too much, unless there's things that happen that none of us could predict for, which I've lived through a few of those. I guess that's possible, but otherwise, I think we'll see it coming. Delayed refi for those, just really quickly, just so I can finish that thought and let it leave my brain. The delayed refi, cash out refinance does not impose the 12-month ownership seasoning, guys. Okay, if you paid cash for the property, your sourced and seasoned funds, and you're expecting to get back a maximum cash in hand of what was listed on that final closing disclosure, there is no seasoning, ownership seasoning required in that example. End of sentence.
If anyone has any questions about the delayed refinance, because I know, Caeli, you've covered it a couple of times, and it is a really weird kind of concept, please post a chat, talk about it on the community, or if you really just want to have a private conversation, just call Caeli or any of the dedicated lending specialists at 855-74-RIDGE, or you can even send an email using info@ridgelendinggroup.com. Just for the benefit of everybody, Caeli, I did post the link to the Fannie Mae LLPA chart in the chat. And then
Excellent.
I also took two screenshots, one for a limited cash out, or what a lot of people know is rate and term, and as well as the cash out in those two images. And it is any DTI greater than 40.00. So 40 is the number.
Thank you, Larry.
You got it.
Thank God for Larry.
So, a couple more questions, or do you want to take questions? Is that good?
Yep, we're ready.
All right, so we're going to go with Edward came up next, and so Edward says, Caeli, I understand that it's normal when rates go up, the cost of goods and property sometimes come down, but it looks like because of lack of inventory on housing, although rates keep coming up, property values aren't really dropping; they just kind of flattened. What's your make of that?
I think that that's probably true in certain markets and not so true in other markets. But I believe, my personal opinion is that even in those markets where we're not seeing as much of the decrease in home values as maybe some had predicted or some expected, I believe that's going to change. And the reason that I can say that, guys, is that the building permits. So if anybody really wants to track this, you want to go and check the national for building starts, how many building permits are being approved. That'll be a very clear indicator of what's to come, and they're finally on the down. Now, for reasons that I think that you're alluding to, you said Edward, right, Larry? Sorry,
That's
Edward, if
correct.
it was Edward.
Yep, Edward.
So there were supply chains disruptions, and of the residential or of the housing building, supply chain disruptions caused some delay. There was a lag in time, right? So there was still new builds and construction that was happening. So for single family residents and then multi and home renovation, all of those were still kind of on the rise. At the same time, we're seeing the building permits start to come down. They're down about 20%. But the reason that we're not seeing the values come follow that yet is because of the supply chain disruption that delayed the amount of time that all those housing starts took. And then that they also saw that the multi-unit, like apartment buildings, was a bigger portion of what was being built. And those do take longer as well. So if I'm articulating this clearly, guys, what I'm saying is that normally when you see those building permits start to come down, at least to the level that we're seeing them now, then that's within a 6-month window of time, we start to see the home prices fall. That should have been October, November of last year. It didn't happen like that because of the inventory shortage and the amount of time they still had these new builds on the books that were still in process. But there was all of this extra inventory or all this new building happening for the two reasons that I described. One, the supply chain disruption, building couldn't complete, it wasn't finished then. And that a bigger bulk of what was happening was for the multi-unit, bigger apartment complexes. I do believe that in the very near future, let's say even within a couple months, we're going to start seeing a turn. We'll see. Today is the 14th of March. Let's say maybe June, around this time on June, let's see how my prediction fares in that case. Eddie, hold me responsible, hold me accountable, okay? Come at me in about June and we'll see where we're at.
Is this the crystal ball that's on the fritz? Crystal ball?
Now, here's the thing. Normally I say that because when I'm betting or I'm, my prediction, my abilities to predict when there isn't empirical evidence or proof, I usually kind of use my crystal ball as a crutch. But there is empirical proof in this case, and we're going back, 4 different cycles dated back to 1970, 1960 something. I do believe I'm gonna come out on top on this one, but we'll see. I mean, there are still variables that I could never predict for that could come up or happen that could derail some of what I'm saying. But my prediction, and I think my crystal ball, I'm going to take that out of the equation. I think that in June-ish of this year, we'll start to see what I'm describing.
So we're going to hold you to it, Caeli. First of all, Edwards put on an emoji there. He's holding you to it.
Okay,
so
Edward.
Sweat it out. So in the chat again, if you're hopefully everybody on the call can see the chat. I put a link to a site that's good about taking the building permit data and flipping it into a chart. And then I also took a picture of the chart. Yeah, the thing looks like a really scary roller coaster going down from a year and a half from the last year up until January, which is the last time those numbers were released.
Thank you, Larry. Nice,
So
Larry.
you got it. So Katie just asked a quick follow-up, and there's other questions. Please keep them coming in. I'm going to give them to Caeli as we have the opportunity here. So so Katie just follows up. If building permits are is the building permit numbers, are they a leading or a lagging indicator? And if inventory tightens, wouldn't you expect that to minimize price reduction since there will no longer be an oversupply in the market? So leading or lagging indicator, and an inventory tightens, wouldn't that minimize price reduction?
Okay, let's talk about the first part first. So leading so the building permits are going to be directly linked to employment and specifically construction. Okay, and then more specifically residential construction, those jobs. When we start to see the jobs report come out and that is going to be affected, that's when, historically speaking, recession looming is when we'll start to take hold. Okay, so building permits is going to be the lead. And then in this case, in this example, in this cycle, the lag is going to be the jobs report or employment report related to construction and more specifically residential. Okay. In terms of inventory, what happens, you guys, is that if the builders stop building and even if inventory is more scarce, the cost of entry and as interest rates go up, I mean, you can have a smaller amount of inventory, but if you can't have people that can qualify, there's not going to be sales, right? Because as interest rates continue to go up, simply if an individual can't meet the debt to income ratio requirement anymore, and as interest rates continue to go up, that's not going to be the case. Does that make sense, Katia?
Hopefully it does. Katie, if it doesn't, go ahead and keep packing stuff in.
Yeah, ask
Shelley,
me.
do you want me to keep going with questions, or do you have anything
Sure.
else you want to throw in?
No, that's good. Let's go to the next.
Cool. So going back to your prediction about June, someone just asked. So what Caeli's on recording to have professed here is by June we should see an improvement to the building permits. That was what you.
No. By June, I believe that the home prices are going to start showing in more of the markets that really haven't been, they haven't been indicative of what we would expect in a rising interest rate environment, right? The housing prices in some markets really haven't been as affected. And I'll give you guys an example. In my neighborhood, there are properties sold across the street just recently for $30,000 over ask. So when I look at that, or when most people look at that don't have the empirical data to use or the historical data, there's no way that I could justify that, how are home prices going to be coming down. Now, in fairness, that could be a one-off in a market. You can't just take one comp among 30 others that sold 4 or below, right? That could just be, it could be a whole subset of other reasons. But the prediction is in June, based on all the data that I've kind of released here today, or whatever, that I think that the home prices in markets that have been unfazed so far will start to see some of that effect, and that the values will start coming down.
There you go. Sorry about that. Yep. Okay. So housing crash by June. Got it.
No, I didn't say that. That's not, those are not my words.
Sorry, that's not what you said. Okay.
That's not what I said.
So let's go back to Prashant. So Prashant's got a lengthy question here. So rates in the past, rates going higher typically bring down costs. It's a historical prediction. But this is really talking about, Prashant wants to talk about the fact that the U.S. has printed more money in the last 5 years. And most of it is banked by corporations and investors, so it's not necessarily in circulation. So do you feel that interest rates are really impeding the amount of capital that's floating around? Do you feel like there's any type of hoarding or anything else that's going on that's, again, really affecting us as a real estate investment group because of how much cash has been put in circulation in the last 5 years?
Prashant, I would have no idea where to even start in that connection. It's outside my wheelhouse. I'd be very interested to hear what others have to say about that theology. If you've got, other data that you can share with us, I want to hear about it. I really don't know, man. I would point more to the jobs report that we're continuing to see come in. It was December, Larry, where it was like 500,000.
That was January. January picked up 500,000 jobs created.
And the prediction was like 180, 185 or something. So I would point to that more than the other in that question, but I don't know, Prashant. I don't know the answer to that.
Great question, Prashant. And sorry we didn't have a better answer for you, but hopefully that helped you out somehow. Denise asks, is the all-in-one a Fannie Freddie product? And is it subject to 50% DTI? What's that look like, Caeli?
Thank you, Denise. No, it is not. This is a what we call a non-QM product or non-TRID. This is not a agency. Fannie Freddie are government-sponsored enterprises. It is not backed by Fannie or Freddie. And the debt-to-income ratio threshold is 43%. But at 43%, the reserve requirement's a little bit higher than if it was 40% or low. So the absolute max DTI is 43. At 43% debt to income ratio, between 40 and 43, your reserve requirement is 15% of the line limit. So if the line limit was $100,000 and your debt to income ratio was 41%, you'd have to show 15,000 in reserve. If you had a 40% or less debt to income ratio for the all-in-one, the reserve requirement is 10% of the line limit. So going back to my example of $100,000 line limit, you'd show $10,000 in reserve.
There you go. So here's a really good question. This goes back to Caeli, when you were talking about lenders kind of getting the short end of the stick when people take out a loan now and then refinance before 36 months. So Jeremy asked the question, wait a minute, isn't that what lock fees are for? Or points?
Yes.
Is that there to
Yes.
protect loan servicers from short-term refis?
Absolutely. That's what, so if you guys are seeing, when you guys have been quoted recently, you're probably seeing extra points that weren't there prior, or, you may have had an option, what was called premium pricing, to not pay points and just increase your interest rate. Premium pricing isn't available, so you're seeing those extra points. And that's kind of the break even mark. I would anticipate it was Jeremy, right? Hey, Jeremy.
Yep,
I would say, yep, that's probably the break even. They're forecasting. But that doesn't absolve any profitability, right? So what they're doing is they're protecting on runoffs and huge losses, but kind of two different things. But good question. And yes, that's what that is.
great question. Caeli, just because you mentioned seasoning when you were talking about the delayed refi, Katie asks, how does one define cash for seasoning rules? Can cash be from a private loan from like friends or family? And do rehab costs count as part of the initial purchase, quote unquote, price or basis that's considered for that refi seasoning rule?
So yeah, thank you for the question, Katie. Let's get into this. So I think what you're talking about is a rate and term refinance, and that's a very, very different thing than a cash out refinance. And this is one of the things that we're coaching our clients right now to get around that 12-month new seasoning requirement. So if you go and you get private money from whatever source, and this is a recorded lien against the property, okay? So you leveraged, you borrowed money from whatever entity, hard money, private money, whatever, and it's a recorded lien, and you have enough to cover the purchase price and all of your repair. And we know that based on that and what you expect or the actual appraised value comes in at, let's say it's high enough that a 75% loan to value to cover the entire payoff of that private loan, there is no seasoning required in that scenario, that strategy. That is a rate and term refinance. A rate and term refinance has very different rules than a cash out refinance. A cash out refinance is defined as cash that you're taking and putting in your pocket, cash in hand. In your analogy or your scenario, Katia, you got the cash from someplace else, but it was in the form of a lien, borrowed funds that were, interest probably accrued or was paid on. That's a recorded lien against the property with the county that we're simply paying off. We're replacing one loan over here, the private money loan, with a new loan. That is a rate and term refinance, different rules, no seasoning. Hopefully that answers your question.
Awesome. Let's see, we've got a few more in here. Emily asks about construction loans. So does Ridge Lending Group offer any type of construction loans for single family investment properties? And if so, does the product allow the ability to count rent from the subject property towards the DTI?
Hi, Emily. The answer is normally yes. Normally, we will have access to ground up construction for investment properties. And yes, that income from that property would be considered as part of the overall income when calculating the debt to income ratio. However, as of about 6-8 months ago, we halted production on that product line. No ground up construction is available because of the anticipation in housing values declining. So as of today at 2:03 p.m. Pacific on the 14th of March, no, we are not funding new construction. I would have you, if anybody's interested in that, check back every couple of months with us, just ping and say, hey, is new construction back on tap or not? But right now, no. Otherwise, yes, and we would count income in the DTI calculation.
Awesome. Alexander, Caeli, if you can cycle back really quick. Again, talking about the delayed refinance. So here's a question from Alexander. Hey, Caeli, just want to make sure that if you take out a hard money loan, they record it in first position. So it's the only lien against the property. Can you refinance that out immediately afterwards without waiting? Would that qualify you for a cash out?
That would not be called a cash out. That would be called a rate and term. But yes, Alex, you can refinance immediately, no seasoning. So I'm going to give a scenario. Let's say that you purchased a property. It was $100,000 for the purchase and you have $50,000 in renovation. Okay. You secured a $150,000 loan from a hard money, private money, whatever. They recorded a lien against the property. You come back to Ridge. We order an appraisal. The appraisal comes back at $200,000. Okay. $200,000 times 75% is 150. Okay, so we're going to give you a loan for 150,000. Now, let's say the closing costs are $5,000 in the refinance that we're going to do for you. So what's going to happen in that case is we're going to fund 150,000. That is going to pay the existing lien to zero. We're replacing our 150 is going to replace, we're going to pay them off, and we're going to replace that lien with this new lien. The $5,000 in closing costs can't be covered because we didn't get a high enough value to justify that extra $5,000. So in that scenario, Alex, you would be coming to the table, your skin in the game would be $5,000, which if you do the math, that's what, 95% leverage. That would be a home run all the way. So just to reiterate, you're not getting cash out. We're simply paying off the existing lien. Now, if the existing lien gave you cash and you didn't use it all, that's your cash, I guess. It has nothing to do with me. I've just paid off the 150 lien that was existing before, and you came in with $5,000 of closing costs because the value in my example wasn't high enough to cover the payoff plus the $5,000. Hopefully that makes sense.
I hope it does. I hope it does. So Alexander says, yeah, that looked great. So thank you very much, Alexander, for that. Maybe time for a couple more questions, Caeli?
Sure, I got it.
Okay. So here's one from Corey, and this is going back because we mentioned a couple of times the all-in-one here. And then we've got a really good question about Kevin Nguyen, who wants you to give some more predictions. So we definitely want to get you on recording for more predictions. Corey asks, hey, we've been talking about all-in-one in the past, and Corey's been reading up on something similar, not called all-in-one. Are you aware of any HELOC that's placed in the first position that's maybe not the all-in-one, and can it be a fixed rate? You ever come across that?
I'm sure there's other HELOCs that will take first lien position, which technically, you guys, whether it's the all-in-one or a second lien HELOC or another first lien position HELOC, the concept of what the all-in-one does can be utilized with an open-ended revolving line of credit. Okay, you can do the same thing theoretically. Now, it's not going to be as advantageous because A, you don't have all the banking features attached to it. B, I don't know what the interest rate and the cap rates you're going to be paying on such a product would be. C, the line limit is likely to be a lot less access than what the all-in-one would allow for. And there's one other thing there too, rate.
Loan to value?
Loan to value. Yeah, loan to value is probably going to be more restrictive than what the all-in-one will. So not only will the line limit be less because they're going to be limited on let's say a second lien, for example, or maybe even the first lien. So loan to value will be less, and then line limit also will be a deterrent. It'll be smaller versus an all-in-one, depending on the value of the property, could be 80% loan to value, right? So if it's $1 million property, you've got 800,000. But if it's a second lien HELOC, as an example, and it only goes to 80% combined loan to value, and you already have a $600,000 first lien, right? There's only $200,000 there. So I know I'm just spitting out numbers. It'd probably be better, Corey, to talk about it on a one-on-one and compare side by side so I can answer more specifically. But overall, the answer to your question is that you can adopt the all-in-one strategy that we've talked about here with any open-ended line of credit. It is absolutely possible as an arbitrage to use a line of credit and pay some form of debt and then utilize your depository incomes driving that down, because an open-ended line of credit, revolving line of credit, is going to accrue interest daily. So if you're simply taking from whatever vessel that you have your depository money in today, or you're setting in every month, pull it from there and stick it in against whatever the revolving open-ended line of credit that you have, driving that balance down, you're going to save interest. And oh, he said in a fixed rate. The all-in-one does have a fixed rate option. You can fix it for I think 3 and 5 years. However, right now in a higher interest rate market, that is not going to be to your advantage. We absolutely think that rates are going to be coming down. So if you were to fix it in now, you're going to be doing yourself a disservice. Now, if you were to get an all-in-one in 2021, yeah, at 4% or whatever it was, and you could have fixed it for 3 years, hell yeah, you should have done that. But right now, I would not advise anyone to fix in a HELOC rate today.
So I lied, and I'm going to get to Kevin's question in 1 second. But pardon me if I mispronounced that name. your name, but the question is talking about HELOCs on primary residences. Caeli, if you have a borrower or if you have a client who's doing a HELOC against their primary today, and the plan is at some point, maybe next year, they're going to turn that into an investment property, would you still want to keep your HELOC on your with the property, or would you think that they might like force you to close it because you're changing occupancy? Like, have you ever heard anything about that?
No, if you're so you put on your primary today, then you're going to go and move and get another primary, and that's going to maintain as an investment. The loan documents that you guys sign on any primary residence mortgage, whether it's a all-in-one or HELOC or fixed or whatever, specifically say that you intend might be the operative there, but you intend to occupy the dwelling as your primary residence for at least 12 months. Okay, so if it's a year down the road and you move or something like that happens and you make it a rental, that's absolutely within your rights to do. And even further, guys, I would tell you that I have seen without liability, circumstances change. Life changes sometimes. So if the language in the loan documents say you intend, and I'm not telling somebody to go out and get this on a primary knowing that they're not going to have it for 12 months. That's not what I'm telling you to do. What I am telling you is that, you know, if let's say your mother falls ill and you need to go care for her in Florida, right? You just purchased this owner occupied in Tennessee, whatever, you're going to have to move to take care of your mom. They're not going to call your note due because that is now a rental property and you've got a new primary in Florida. Does that make sense? Hopefully that gives you some perspective.
I think we're good with that. Listen, and I know there's questions on here. Katie asked a question, and we've got one more from Prashant, but I'm gonna, because we're on a 45th minute here, I'm gonna have you end with something that is again speaking back to how we started here with the subject, like what's going to happen for the rest of 2023. So Kevin's question is timely on topic here. So in this climate, Caeli, what do you think the best financing strategies look like for the next 12 to 18 months?
Kevin, I would say that I'm going to stick to my stock answer in diversification. As long as the property is cash flowing in the right market, that you see the upside of tax benefit and future appreciation in rents and housing, I think it's going to be a good deal as long as you are diversifying in the heavy cash flow, high appreciation, long-term, short-term, mid-term, single family 2 to 4, some appropriate combination of all of those things. That should be your strategy now and forever. Forget about 12 to 18 months. I would say past, present, and future. That's going to be my overwhelming advice for my clients, is to make sure that your portfolio, based on your qualifications, your needs, your goals, right? All of those things, it's appropriate to have some balance of all of those different strategies and real estate dynamic solutions, so that you've got more legs to your stool, right? You don't want to be a one-trick pony. I've fallen victim. I'm never a victim. That's not the right choice of words, but I have been in that place where I was a one-trick pony. At the height of my aggressive acquisition, all of my properties were about appreciation. None of them cash flowed, believe it or not. Honest to God, that's a true story. And if, you know, going back 25 years when I was just a pup, knowing what I know now, I would have been better diversified in my real estate investing. I would have had cash flow and appreciation, as long as they all cash flow. Okay, I'm not saying there are circumstances where some investors will take a loss, a negative monthly on an investment, but those are very specific circumstances. But some cash flow, appreciation, look for 2 to 4, look for single family, look for midterm, look for some short term. You know, one of the things that I talk about, and I've been talking about most recently, is that if somebody can find a fourplex, okay, in a market where you've got some good appreciation as well, and typically speaking, the higher the appreciation, the lower the cash flow on a long-term rental. Typically, not always, typically, and vice versa. The higher the cash flow, the lower the appreciation on a long-term rental, usually a single family. But if you can find a 4-unit property in a market that will also provide for some appreciation, and it also allows for short-term rental in that municipality or that township, what you could do in that case is you've got 1 or 2 of the units for a long-term tenant, 1 for a midterm, and maybe 1 for a short-term. right? New construction perhaps, so you don't have a lot of maintenance attached to it. So Kevin, that was a long-winded answer to say your strategy certainly is going to evolve, but I think overall balance and diversification in your portfolio is my answer.
There you go. So Katie, you've got a question. Prashant, you have a question. And Kevin, you have a question. I'm going to make sure, Caeli, that we get these over to one of our dedicated lending specialists to follow up with additional answers. And that way we can make sure everybody's taken care of. Also, of course, if anybody on the call listening now or live has any follow-ups, anything Caeli's covered, please call over to 855-74-RIDGE or email to info@ridgelendinggroup.com. And I know we talk about this a lot, but Certified Power Buyer program is still rocking and rolling. You have a bunch of people showing up for that, Caeli, because they want to make sure that 2023 into 2024 makes sense for them.
I love it. I can't wait to see you guys one-on-one. It's one of the favorite parts of my job, is working with our clients together to plant those seeds. So let's do it.
Terrific. So I'm going to call it today because everybody's, I'm sure, got something else they have to get to, and we always love everybody coming. So thank you very much for coming. Caeli, thanks as always for doing these. I know everybody truly appreciates it.
My pleasure. I'm happy to be of service, and thanks you guys for showing up too.
Take care, everybody. Have a great rest of your day.
Bye, gang.